Aloha, this is Michael with Helius Capital Investments. Hey, I've been asked to share my deal analyzer with folks when I find good deals and I'm looking for JV partners or operator partners. And I have decided to go above and beyond and actually share deals that I choose not to move forward on. And I'm going to start what's called deal or no deal. And no, I'm not copying the game show, but basically, when I go through these, there's some key things I look at, and I'll do a quick snapshot. And if it looks like there's potential and it might make sense, I'll move forward. If in that quick snapshot, there's just not the things I'm looking for, then I quickly step away. And this particular property, I've actually not only looked at it potentially as an acquisition, but potentially as a basically what we call a wholesale deal, where might be able to find and put under contract a property and find another potential investor or group to pick the property up and make a little income for locating and doing the quick underwriting. But this property, as you'll see here in a minute, doesn't warrant an acquisition or a wholesale at a snapshot. And of course, these numbers are rough numbers and pretty down and dirty. And if there was a little bit of possibility, I would move forward. But the numbers are low enough here that I'm just not going to move forward on it. So the first episode of Deal or No Deal is a property that's called Pine Village, which is a 26-unit complex located in Texas, and they're asking $2.6 million for it. It is currently running a 95% occupancy, which is good, and there is still a little room for market value add in rent increases based on basically the highest rent of comparable units within the complex. For example, if a two-bedroom was going for $750 and 10 of the units were below $750, simply just bringing up all the other ones over the next 12 to 24 months to that $750, not even increasing to market rents outside of the facility, there is a potential of almost a $34,000 value add. And there might be a little bit more on that, but as you'll see as I go through, it's not going to warrant it. So basically on a property that's 2.6, down payment at 7525 LTV, that's a 650 down payment, and you factor in appraisal, inspections, a little capital improvements, and I understand this property is in pretty good repair, so it doesn't, CapEx improvement on this side is going to be something that's immediate. And even if it's not immediate, it might be just a little reserve fund. So you could pull that out and you could pull the acquisition out, and it's really not going to make any difference on this particular one. So I'm just going to leave them in right now for the underwriting purpose. If you did a simple JV agreement, it'd be $1,200-1,500 for attorney fees. If you got into a larger project, more investors and syndication, it would run roughly between $12,000 and $15,000. Closing costs are about 1% of the sales price. Acquisition fee is something we do when we acquire properties because of the amount of time and effort it goes into finding properties, good deals that are going to make a nice, comfortable, income for our investors, and with a potential above average exit income, so return on their investment. So that's what an acquisition fee is. So the balance of your 75 LTV is going to be 1.9, which is, or 1.950, which is your mortgage. Just do a down and dirty with a 25 AM, 4%. That's going to put your debt service at 123. Snapshot on their current expenses. Their taxes were a little bit lower. I factored in about 20% increase on that, so it's about $52,000. They're currently at 13.5 on insurance, so we should be able to be somewhere in that ballpark. Maintenance, if it's in good repair, management, 10% is kind of the given, but if you have sizable properties or more properties in a portfolio, normally that's negotiable. So I factored in 8% on that. Loss to lease, they don't really show big numbers on loss to lease or big numbers at 95% occupancy. So I just figured a simple 5% vacancy, which will cover any, one or two that go out during the year. So repairs, I factor in 10%. Honestly, if it's a good condition building, you can go down to 8%. But again, that 2% is not going to make a huge difference in your overall yearly numbers. Utilities, they are claiming they're at 22,689. They are picking up some of the utilities in a RUB system. That number over here in the income also reflects some additional income that they're picking up. I just didn't break it down. I put it all into one. So there may potentially be a little bit bigger gain for RUBs, but not a whole heck of a lot. Miscellaneous was just their bank fees and things of that nature, asset management. That is for if we were to acquire it and we are managing the managers and taking care of everything, we normally get a fee on top of that. It takes care of, making sure that, the accounting is done on a monthly basis. It comes in, we do what we need to get all the information over to our investors. So basically managing the managers. So our total expense, 152, and as you can see, our income, even with the RUBs or additional incomes, 276. So at the end of the day, our net after debt service and everything is only 253 annually. So that is pretty much a 0% cash on cash, which is that monthly return. Now, that is not 100% out of the question if your forced appreciation was a bigger number, where maybe you don't make as much money over a year, 2 year, 3 year, but you have a very big value add. And typically what you're going to find is you're going to either find a really big, monthly income and a very small forced appreciation or value add, or vice versa, a very small monthly with a really big value add forced appreciation. In this particular case, it is it's actually both. You've got a very small cash on cash monthly return, and you have right now you don't even meet my minimum requirements, which is going to be you would need about 1.25% of that 744, and even though at 6%, and let's just change that to 5, it's 673. So you haven't even met the 744, which is if you were going to do a cash out refi or a sale in especially a cash out refi, you would want to be at 125% of that cash needed so that you could pay off all that seed money. And we don't even meet the cash needed mark there. So for this property, deal or no deal, this is definitely a no deal on the acquisition. And because there is no room for any further investors or future investors to take and earn any income on this, which is if there was, potential for cash on cash or forced appreciation, and we can do a pass through on this, this is something we would do an underwriting on and then market it as a wholesale property to other investors. This does not meet either one of those criteria, so this is a no deal. Thanks for tuning in. Again, Michael, Helius Capital Investments, and we'll be back with more deal or no deals in the very near future. Aloha.